Right. Sorry for a few minutes late. We'll continue our discussion. Any questions you all want to continue from our previous point where we stopped our discussion with respect to interest rates behavior, because it's one of the major topics that we were trying to understand. So the understanding interest rates behavior continue to remain one of the key areas for you all to follow in this program. And of course, now you have some understanding in terms of different types of credit market instruments that we were looking at. Simple loan to fixed payment loan to coupon bonds and discount bonds. And very interestingly, you learned about so-called yield to maturity. That is very, very important concept in terms of how you wanted to see an investment return and what would be the ultimate return when it comes to a asset that one wanted to look at, mainly in the form of financial assets like treasury bonds. Okay. And then you looked at embedded feature of coupon bonds. And then from coupon bond, you can always see the current yield also being looked at. It is very simple in terms of C over P. Okay, coupon over price is the current yield that you will be looking at. Okay, and then we stopped at the point where we have only looked at return, but not looked at kind of the distinction between capital gains that's derived from the price differences of financial assets. And to start with that, you might see for a discount bond, what the difference there is, you might not see a discount bond is paying you a interest like other financial assets. Often, discount bonds you buy at a price, that price is below the face value of that bond. And as the time moves on, you get closer to the maturity date. So what happened there is price accumulate from the date that you purchase to the date that you are holding this. The price accumulate, and ultimately at the maturity date, it gets to the face value. In Sri Lanka, it is 100 often, and in US, it is 1,000. And similarly, in most countries, they price it to 100. So what you are basically doing in a discount bond is to get a return. What you do basically, you buy this bond at a price below its face value, and let this face value to accumulate. And this face value purchase below the first face value that you are purchased varies based on your interest rate expectations. At times, if the interest rates are very high, at price at which that you probably be buying this would be low. And similarly, if the interest rates are low, the price would be high. So this is the negative relationship that we were talking. Okay. So when it comes to a discount bond, the interest rate is nothing but the difference between face value and the price that bond is carrying. And you can make this as a equation to figure it out. Face value is F, price is P. So F minus P over the price. Okay. So it's a very simple to say that you can figure it out in this instance. Most of the treasury bills that you come across in the market do not specify a return in the form of a interest, periodic interest payment like a treasury bond, like a coupon. What you are basically seeing in treasury bonds, treasury bills is that you buy the bill at a price below its face value, and let this price to accumulate, and at maturity you get the face value. Okay, so most of the treasury bills are discounted financial assets. Discounted financial assets, and there are bonds also. In normal parlance, you see bonds with a coupon, but discounted bonds also available, and even coupon bonds could be purchased at a discounted price if the coupon is, you know that, if the coupon is lower than the interest rate. Okay, so it could be either premium price, discount price, par value. That's the general bond purchase prices. But discount bonds always carry a price that is below its face value. And mostly the treasury bills are discounted financial instruments. Okay, the yield to maturity, YTM, equals the increase in price, okay, over the years divided by the initial price. For instance, if you see you have purchased this at let's say 90 rupees, face value is 100. So 100 minus 90 over 90 is the yield to maturity in the case of you hold this bond until maturity. So you can figure it out, right? What's the total return that you are getting in terms of a discount bond by doing that computation. And it's a kind of a direction that you wanted to know. And as with coupon bonds, the yield to maturity, again, negatively related to the current bond price. If the yield to maturity is increasing, means the bond prices decreases. If the yield to maturity is decreasing, means the bond prices increases. So that's how often you see these bonds and interest rates behave, price and interest rates behave. It's negatively. So you can see in discount bond case also, yield to maturity, YTM, is nothing but your initial purchase price versus the face value at the maturity that you are receiving. The difference between this would decide what's the yield to maturity of a bond or a discount bill that we were talking. But interestingly, if you wanted to take your position liquidated, that means you wanted to sell your holding of this bond before the maturity, right? So then you try to figure it out, what's the return of this particular bond is. You are not selling at face value, then face value is at maturity, but based on the interest rate determined price for that bond prevailing at that point of time. So you have purchased, as the example we discussed, at 90. Let's say you sell this in the interim period from the purchase date to the maturity date. No, you are not holding till maturity date. In the halfway through, you are selling it at 95. So then the price difference, 95 minus 90 over 90 would be the return of this discount bond that you have sold prior to maturity. Then it's not yield to maturity. You are not holding that till maturity, but you are selling it based on your cash flow expectation. This is very common in, let's say, treasury bills. You buy a treasury bills for 1 year, 364 days. After 200 days, you sell this. You sell this maybe based on the interest rates prevailing at that point of time. If the interest rate has decreased during this period, compared to your original purchase point, price would have actually increased. So the return that you are gaining is for the holding period plus the reduction in interest rates given price accumulation. So that component also there. Still you can calculate that. There is no a problem with that. But what is the underlying logic there is, when the interest rates decreases, the price increases. And the price decreases, interest rates increases. It's negatively related. So that also works for discount bonds, and discount bonds are one of the most sought after money market instruments in the form of treasury bills in all around the world. So now we are coming to the point where sorry for the technical glitch. Yes, we can continue. I mean, we were discussing about the discount bond, and then we came to the main point that we highlighting, the return. So the distinction between interest rates and returns. So when it comes to a investment, you now have a understanding that it carries so-called coupon return, or for that matter, interest rate return. But at the same time, you have another component, as I was explaining to some extent in the discount bond. There is a component called the price driven return that you are gaining through an investment. This is very important, particularly for longer term financial assets, mainly for treasury bonds. If you hold it for quite a long period of time, you know the treasury bonds are even up to 30 years, even up to 50 years. Not in Sri Lanka, but in other countries. Some countries have so-called perpetuality. So perpetuity is nothing but there is no defined maturity time. Okay, so this investments that you make is for longer duration. So longer duration financial assets not only carries the interest or coupon driven return, but at the same time they have the price driven return. So this price driven return is another component that is to be factored when it comes to assessing, computing, compiling a total return. Okay, there is a payment that you know now through coupons or interests periodically paid with financial assets. But at the same time, there's another component. We have to plus that. That is the change in value, okay, expressed as a fraction of the purchase price. You know now, return, if you look at it, C over PT, that is the current return. C is the coupon, PT is the price at time T. If it is today, we say today is T, price T is today's price. So the coupon over price would give you the component called the current return of this asset. And then you have to also factor the price driven or the value driven return of this financial asset in the form of PT plus 1. If you wanted to hold this asset not to the full period, let's say 5-year bond, you are not holding this until the lapse of five years. So what you are basically doing is after 2 years, you wanted to sell this. So the price at second year of this 5-year bond, we assume for the time being as PT plus 1. Price at T, today's price, T plus 1. Usually we say it's 1 year from now. T plus 1 is 1 year, T plus 2 is 2 years, right? So for this example, I just took 2 years. For further simplicity, okay, let's keep it as 1 year from now. Okay, T plus 1. So the price from 1 year from now is either accumulated or reduced. The reason is the interest rate structure that would prevail at that point of time. I cannot precisely say what the interest rates would be 1 year from now, but I could generalize the interest rate direction for 1 year or 2 years from now would be either increasing or decreasing or more or less remain the same. So it's a kind of a general direction we all can give. But most of the time what you are simply seeing is we cannot precisely quantify what the interest rate would be 1 year from now. That is very challenging. You can guess your chances by quoting a number, but it's not going to be the correct number that you would be looking at. So the current return, C over P, plus price value driven return, that is derived from PT plus 1 minus PT, price 1 year from now minus today's price over today's price PT. So that component is also very, very important. And most of the time, what you basically see is any investor who buy a bond of long-term nature would sell in the market when he see a price or value accumulation to his investment. So often the prices increases when interest rates decreases. Okay, if you see an interest rate structure 1 year from now decreases, he is in a better circumstance to gain a higher value driven return. So he would try to sell it that in the secondary market. Then his purchase price at PT would be lower than the price at which he would be selling. So the accumulated price driven return also need to be brought into the equation. Okay, so the explanation here is you are not only have the current return from a investment, but there is another component called value driven, price driven return in terms of the investments that you made at a different point in your investment horizon. So you come in at time T and sell this at time T plus 1, let's say 1 year from now. So then you have either accumulated or decumulated, if not reduced. So it could happen, right? So most of the time you try to sell this when there's a price accumulation. So price accumulation or price increase happens when interest rate structure decrease. So this been very clear in the sense that you try to understand here, PT is price of bond at time T, let's say today, PT plus 1 is price of the bond at time T plus, let's say 1 year, okay? C is coupon, then you know C over PT, today's price, that would derive IC, that is current yield that we have looked at in our last week's few slides throughout last week's discussion. And then you have the second component, PT plus 1 minus PT over PT, the price at time T plus 1, that is 1 year from current price, minus price at time T, that is today's, over price today. That would determine the so-called G, small g, that is capital gain. If you have sold the bond that you purchased at 101 rupees today to 104 rupees in 1 year from now, that 3 rupees that you have accumulated is nothing but the capital gain. Because when you invest these in many millions, billions, that 3 rupees is very big. And markets are very keen to see the component of this G over and above C over P, that is the current yield. Current yield is changing because prices change with the interest rates changes. You know, when the interest rates are low, prices tend to be high. When the interest rates are high, prices tend to be low. But the coupon, that is usually fixed. If they say it's 10%, that 10% remain until that bond get matured. So you receive periodically that coupon, but the price changes. So based on the price, the current yield also changes. And the change in this price opens up an avenue for you to look at in terms of what price you purchased versus what is the current price. So if you see the current price is beneficial and you expect future interest rates also to increase, you know what happens to prices? Prices decrease. So today's price is attractive, future prices to decrease. So you sell and accumulate this capital gain component. So when it comes to return of an asset that you invest, you have to always look at not only the periodic return accumulating from that asset, but also the component that comes with value changes, price changes, right? So that component is called capital gain. Okay, so this could be negative, then it's capital loss, right? Even they do, investors, they do. If they are not sure that whether this issuer or the borrower would honor my obligations, why I want to keep this for 5 years, 10 years, I better get rid of this bond right now. I'm not sure whether his financial status would be right. So they sell it, even at a loss at that point. Okay, so the capital gain or possibly loss is also a component you have to bring into the equation when you compute the return. So that is very clear in this expression here. So we would be able to further detail it out as we move on. Any questions that you wanted to pose at this point? Right. So we can move on. And some of these areas that we are discussing would not necessarily be difficult to understand once you see the next lecture. That also would give you some insight of easy practical understanding of how interest rates behavior in financial markets and for literature and academic purposes. But what is interesting here is underneath those concepts, what actually happens in the financial markets is this. That understanding is very important. Okay, so then you see the distinction between interest rates and return. Okay, as you simply see from our old discussion, return equals the YTM, yield to maturity, okay, only if the holding period equals the time to maturity. That means you already know you do not offload this bond prior to its maturity. You hold that bond until it gets matured, right? So then you are not exposing yourself to the price changes in the market. So your return and YTM are equals, because at the time of investment itself, you know what the price that you are investing and what's the face value you will get at maturity is known to you. So you can put the same equation, and instead of PT plus 1, you can put F there, face value, and it's 100. You get the 100 at maturity. So if you hold this asset without selling it in the interim period until it's get matured, you get the face value. So the return and YTM would be same when you see your investment is held until its full time of maturity. So you don't do any transaction in the interim. Where interim that you do a transaction, you get exposed to the market price, market interest rates. Then see, a general understanding, you already know the rise in interest rate is associated with a fall in bond prices. When the prices increase, okay, in fact, right? I think there's a small technical problem with this arrangement today. I'm getting few messages here and there. But anyway, so what you are basically seeing here is, right, you are seeing the technicality that prices increases means interest rates decreases. Okay, increasing prices means, right, interest rates decreases. Any rise in interest rates mean prices decreases, right? So negative relationship with price and interest rates, lower the interest rates, higher the prices, higher the interest rates, lower the prices, okay, makes the investment to have a capital loss or a capital gain, okay, depends on the market circumstances that you are exposed to yourself. So if you wanted to hold this asset for a shorter duration than maturity period, you get exposed to the price volatility, right? So when you see this price volatility, you might have a capital gain, you might have a capital loss. If you see a capital gain, that means your prices have increased, the general interest rate structure would have decreased. So if you see an environment where interest rate structure has increased, the prices would have decreased in comparison to T1, time T plus, not T plus 1 price, time T, where you invested at price at the time of purchase. So compared to that price, you see the prices would have increased if the interest rate structure would have declined. So you see this possibility in all financial market transaction assets. Okay, so another very, very interesting aspect here is longer the duration. Longer the duration, rather than a 2-year bond, you look at a 10-year bond, a change in interest rates by one small a minute percentage of interest rate, you see that has a sizable change in the price component, because the change that we are looking at is per year, per annum per se. Interest rates from 6% has now decreased to 5.95%. So the change is only 5 basis points, 6 to 5.95, 5 basis points. 5 basis points into 10 years is equivalent to about 50 basis points. Okay, so the impact to the price of a longer tenor asset is greater, whereas a shorter tenor asset would have a smaller change for an interest rate change. Like what I explained now, if it is a 1 year, it's a 5 basis points adjustment. So the adjustment for the price would be relatively small in comparison to a longer duration 10-year bond, where the adjustment would be equivalent to about 50 basis points. The price would be much sharply adjusted. So you see these possibilities in financial assets. Okay, so then the more distant the bond maturity, that means longer term, the lower the rate of return occurs as a result of an increase in interest rate. That's true. Increasing interest rates, what happened to the price? Price would decrease. right? So when the price decrease, that second component that we were looking at, PT plus 1 minus PT over PT, that's a capital gain component in the equation. You see, when the interest rate increase, the prices decrease. So T plus 1 price would be now smaller or lower than the original PT that you accumulated this asset, purchased this asset. So you are making a capital loss. That capital loss eat into your coupon return or the current return component also. So the lower return occurs as a result of increase in interest rate. So often the market participants would try to avoid selling at a higher interest rate environment simply because they would expose themselves for capital losses. But then still they sell if they see lasting 10 years in terms of this issue or the borrower is not necessarily a right decision. So they are uncertain whether he would honor or he would become bankrupt, right? So he would try to offload his position and try to get the price available in the market, even at a capital loss at that moment of time. But interestingly, if this is longer in duration, the impact from an interest rate increase is much stronger in the price compared to a shorter duration bond where increase in price, increase in interest rate have a reasonably lower impact to the price. Okay, so even if a bond has a substantial initial interest rate, let's say higher initial interest rate, generally when you buy at a very high interest rate, the probability that interest rate further increase is lower. Okay, but you cannot discount that possibility also, because still if returns could be negative if interest rates rise even higher than that point. But more chances in an environment where you purchase your financial assets at a very high interest rate, the interest rates to reduce going forward. So if the interest rates reduces, what happens to the prices? The prices increase. So then you have a capital gain coming into the equation. So these are the elements within the interest rate and return comparison that you have to remember. This is very interesting as well as very practical if you are working in a treasury, if you are working in a financial institution and engage in investments related and financial assets review and analysis or monitoring. These elements are very much important for you to understand. That would help you not only in terms of understanding the subject, but also to be practical in market circumstances. Any questions? Right. So you see this a possibility, and then at the same time, you can also see, right? We look at the prices of different maturities. As I was explaining to you, longer the maturity, more distant to the maturity, the impact is greater, right? So you see here, interest rate changes, that means increases from 10 to 20%. This is an example. You can do the calculation through the equation, but your understanding would help here that coupon rate is no change, it is 10%. The maturities are 30, 20, 10, 5, 2, and 1 years. Okay, so the initial purchase price is also $1,000 face value in US, right? So when they purchase all at coupon rate 10%, they purchase coupon rate and the interest rate, both are 10 mean. They are buying also at face value. Okay, you remember our last week's discussion. When you see coupon equals interest rate, you are buying at a par price. Okay, the face value. When coupon is lower than, okay, lower than the interest rate, right? You buy at a discount price. When coupon is greater than interest rate, you buy at a premium price. We discussed these things last week. But now you are seeing this example where you see the return in terms of at the time of purchase is interest rate is equal to the coupon rate itself. So as a result, you see initial price is no different to the face value. Then interest rate increases from 10% to 20%. Okay, that is next year. So you see this happens at the end of first year. So the financial asset you purchase for 1 year, the interest rates change is no effect because it's already matured at the end of first year. So he gets the entire face value 1,000. But 2-year financial asset, where the interest rate was 10% at the time of purchase, but now after 1 year, it has changed to 20. So see the price next year. That is 917. Right? Interest rates have increased. As a result, the price has decreased from 1,000 to 917. And you already know distance to the maturity is longer, the impact of the price is greater. So we looked at 2-year, now we look at 10-year. 10% has increased to 20% at the end of first year. So 9 years to go from now to the maturity. So the 10% has now gone up to 20%. So the price of 1,000 has now declined to 597. And similarly, you can see the impact to a 30-year bond. Okay, the impact is greater as the maturity is longer. So what you simply see is 10% has increased to 20%. As a result, the price has gone down to interest rate increase, price decreases from 1,000 to 503. So capital gain or capital loss. Okay, as a result of the change in interest rate, you can see the first year rate of capital gain is 0 because no change to the price. This is PT plus 1 minus PT over PT equation of the equation that we discussed. Change in price at period T plus 1 minus PT, the price at which that you have purchased this, over PT, the price at which that you have purchased this asset. 917 minus 1,000 over 1,000. You see 2-year bond has a rate of capital gain, actually capital loss, minus 8.3. And similarly, 30-year bond, the impact is very stronger. 503 minus 1,000 over 1,000. Right? It is 49.7. And then you see rate of return. Coupon over price, PT plus PT plus 1 minus PT over PT. That's second component. That is 5 and 2. We are combining together to compile the rate of return. So 10 minus 49.7 minus become plus. So 10 this component become taken out from the initial yield. So you see it is only 39.7% in terms of 2 plus 5. Okay, so you see the element 2 plus 5 is already minus, and 10 is the coupon return, that is column 2 here. So you end up with a return of minus 39.7 for 30 year. But for 2 year, still you see a positive return, 10% coupon plus minus 8.3. So it is minus 8.3. So it is 1.7. So you can very clear from this example, the interest rate change is much stronger in terms of prices for maturities which are longer in nature. Longer term assets would have a significant impact on changes in interest rates. That's why you probably see when it comes to financial assets in the market, although short-term assets prices change much sharper, the long-term assets does not necessarily take the interest rate change in the same magnitude. Short-term interest rates changes from 10 to 20, but longer-term interest rates would change only marginally, not effectively see entire 20% changes. This is an example that we have highlighted to show that impact is very stronger for longer term assets when the interest rates change by the same magnitude. But when the financial markets experience is concerned, the same magnitude changes weaken as you go along the maturity path. This is where the learning of monetary policy would help you, where you see when the inflation is very high, central bank increases the interest rates. Okay, so when the central bank increases the interest rates, inflation tend to reduce in the coming years. So what it means is when the interest rates are increased in the immediate years, the general interest rates also increase in the market. But going forward, inflation would be lower. So the market participants do not expect same high interest rates to remain in longer term. So they expect lower interest rates for longer term. So they average first year 10%, second year 9%, third year 8%. So if anybody wants us to see 3-year return, 10 plus 9 plus 8 divided by 3. Right? So he gets a lower number than single year, 1-year instruments, that is 10%. So the interest rates tend to be lower, even if the changes are much stronger in the shorter term. But what is the message from this table here is when the interest rates change happen, assuming the same magnitude across the time periods, the impact is stronger for longer duration. But in essence, the market would not necessarily factor the same impact of 10 to 20% across all maturities. Maybe for shorter tenors, yes, but as the longer tenors approaches, the market would not necessarily make 10 to increase up to 20. It might be 15 or 16. So then the impact would be lower, but still you see the price would be much sharply declined compared to shorter tenor assets. So this is maybe difficult for you to at once to grasp it, simply because you are not used to this type of analysis, but get the message across. As I was mentioning, the impact of interest rates change is stronger for longer tenor assets in comparison to shorter tenor assets. Okay, so that's the message you have to take it, and then you can expand it as we discuss in coming lectures, and you will get that with much more clarity as we move on. Any questions before I move on?
So can you just, excuse me, sir, can you just do that sums on the board, sir? When you are explaining, it's not that much of clear.
Right, right. I'm not having all this stuff to do in the board, but I will be very simply explain it to you in terms of a very simple example, right? So when you buy an asset for 1 year, right? So assume that the return is 10%. Okay, so let's assume it's a discount bond, right? So discount bond, there is no coupon. Okay, so 10% return that you wanted to achieve in 1 year means you pay 10% less than the face value. So you most likely would do 90 rupees, or let's say closer to 90.5, because the bottom is always again comes with the PT. PT is price at purchase point, time T. You are not buying at 100 now. So 100 minus PT 90.5 over 90.5 would be the return, 10. So when the interest rate increases to 12, if you are a buyer, right? So you have to see that increase from 10 to 12 is 2%. So that 2% is now required to adjust from the price. So what you are doing there is, instead of 90.5, 2% is almost like 2 rupees O, because I'm telling PT should be in the bottom of the equation, denominator, right? So it is about 1.95 cents. It is less than, slightly less than 2%, because this is these are computations, all decimal places matters. So you see there, instead of 90.5, you are actually making 88.55. So that 2% adjustment is reflected in the price. So that is to say, when the interest rate increase, the price is decreasing. Similarly, when it comes to asset of a 10-year magnitude, from 1 year I explained to you just now. So that 2% adjustment is effectively 2 rupees that we were talking here. 10 has increased to 12. Okay, but you have to simply see there, it is only for per annum tone that we express. The interest rate is expressed per annum. So 10% has increased to 12%. For 1 year asset, you have simply seen now, because of interest rates change, it has moved from 90.5 to 88.55. Okay, but 10-year, this 1.95 adjustment has to happen for 10 years. It is effectively 1.95 into 10. So it is 19.5 rupees. So 19.5 rupee adjustment from original price of 90.5 is nothing but 71. Okay, so effectively you are seeing the impact of 1 year asset to 10-year asset when interest rates change from 10 to 12. So 10 is almost 90.5, and 1 year asset, because of the 10 has increased to 12, reduced to 88.55, right? And 20-year asset has reduced to 71 rupees simply because that 1 year adjustment has to happen for 10 years. Okay, so that's what this equation has done all throughout, right? So underneath this, what you are basically seeing is this adjustment has happened for the duration. So the longer the duration, it's like more distance you have to travel, right? So it is one distance, 1 kilometer to 10 kilometers. So you see that effect for 1 year has to repeat across the balance 9-year periods also,
So
right?
can I disturb you for a while? Here in this column, it shows the first field. It shows the 1 year to maturity when bond is purchased. That
Yes.
is what is that description, sir?
Sorry.
In this diagram, first
Yes.
field shows 1 years to maturity when
No, no,
bond
no,
is
no.
purchased.
Years to maturity.
Years
One
to
is
maturity.
years to maturity. One,
Ah,
two, three, 4, 5, 6. Those are column numbers.
all right.
Okay. So years
Oh,
to maturity. That's why the last column say 2 plus 5. You are adding second column and the fifth column. Anyway,
oh,
what you have to take from the details is always when the interest rate increase, that's very unfortunate that you don't get directly to see the class and the explanations, where you probably see certain jargons that we always practice in live sessions, in the discussions, where sometimes even I ask people to uh, okay, from now onwards, when you take each step, talk to yourself, tell to yourself that higher the interest rates, lower the prices. Lower the interest rates, higher the prices. So you can do that in your home or wherever you are. Each steps that you take, just get that message into understanding. So the prices reduces when the interest rate increases. So price and interest rates have a negative relationship. But this negative relationship become much more stronger or significant when it comes to longer the duration of the financial asset, because that has to repeat across the time. If it is 10 years, it has to repeat 10 times. Okay, that is for the example, but in realistic, in a practical market sense, that's why I was repeating few times. The shorter tenor interest rates may increase from 10 to 20, fine, but the longer tenor would not necessarily increase like that. Yes, it would increase because short term has really increased. It's doubled effectively, but the longer tenor would reduce that increase simply because of the short tenor increase, future interest rates expectation also reduces, because increasing interest rates would signal people's ability to consume reduces and inflation becomes lower. You increase interest rates to fight inflation. So longer tenor inflation reduces, ability to consume reduces, right? So that itself would bring the interest rates to decline. So you will see this type of explanation as we look into central banks and its behavior, the monetary policy, right? So that's where the application, interesting application, come into the equation. Okay, so then the interest rate risk. This is also an interesting element where interest rates are not remain the same all the time. It changes. When it comes to financial market, each minute or each hour, you probably see a different interest rate. And that's why now you have the concept called mark to market. You price your portfolio, you mark your portfolio to market interest rates. So market interest rates changes. So you have now all the Excel sheets, all these program models and packages. So you have all your investment assets there. And you put interest rates for different assets based on market interest rates prevailing at that moment of time. Right? So the screen itself, they have linked. Okay, when interest rates change, that get linked to the portfolio that you have. So it reprice it. You calculate, it's there in the equation, calculate immediately, and you see the price changes. So either this price change would make your portfolio to look valuable than what it was or less valuable than what it was. So even for understanding that in general parlance, the screen would reflect portfolio has become green or red. That means the value has erased out. Green means value had accumulated. Generally, they give that impression. But what is interesting is why that happened. Because interest rates changes. Okay, so prices and returns for long-term bonds are more volatile than for short-term bonds. As you already know, longer the duration, uncertainty is greater. Anything could happen. You take a view from now to 10 years, many things could happen. Right? Uncertainty is greater. But short term, let's say 1 year, right? Reasonably, yeah, still anything could happen, but reasonably less than a 10-year bond. During 10-year lifetime, many things could happen, whereas 1-year bonds, yes, many things could happen, but not to the extent of a 10-year bond. So what it effectively makes you to understand is the longer the tenor, volatility is greater. The prices and returns for long-term bonds are more volatile. Even as we were talking, as 1 basis points change would have a significant impact on prices for longer-term bonds compared to short-term bonds. Okay, so that's very interesting element of interest rate related risk. Okay, then there is no interest rate risk for any bond whose time to maturity matches the holding period. You neutralize this interest rate risk by taking out the possibility that you do any trade in the interim. So you buy today and you know maturity is 10 years, you don't do anything. So you know your return each year coupon is 10%. And final year you get 100. At the time of purchase itself, you know that. At the time of maturity also, you will get that realized. Unless somebody default. That's a different equation altogether. So you take out the interest rate risk by holding the asset to the maturity. That's why the more amateur, if not less sophisticated investors, don't try to do trades. They buy and hold till maturity. So they don't take the interest rates volatility in the interim period. Yes, in the interim period, as I was telling, mark-to-market portfolio would show you green, red, green, red, 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 green, green, all this during this period. But you don't get that realized because you don't do the trade. You just keep it, okay, I'm not touching it. I will just leave it till maturity. So I purchased first year, sold 10th year, that is the maturity period. So my return is all throughout the coupon and any price difference from purchase to maturity. At maturity, that would be the face value. So you know at the time of investment what your return, you know what's the actual accumulated and realized return. You take out the interest rate risk by holding maturity until its original maturity period, right? So you basically take out the interest rates risk, but you are exposing yourself if you try to do a transaction. So the market are for competent participants. They know to see the benefits of these changes in interest rates, then the expectation, and they take positions on that basis. But you also, actually, the initial movement, you probably purchase to hold that until maturity. But during the lifetime of that bond, you become, all of a sudden, you require some liquidity. You need funds for uncertain developments. Somebody becomes sick, you wanted to expand your house, you wanted to buy some assets, you want to have a wedding, whatever, you need money. You can't wait till 10-year lapse to start this. So you go to the market and sell, and then you take the interest rate at that moment of time in the market. Then either you have made capital gain, you have made capital loss. That would decide what's your return is. So that's very, very interesting element that you have to understand from this section of discussion. The interest rates and the price behavior is negative. Prices and returns for longer term bonds are more volatile than for shorter term bonds. There is no interest rate risk for any bond whose time to maturity matches the holding period. You take out that from the equation. Okay, anything happens in the surrounding, I don't care, my return is fixed. I'm not touching anything, I'm just holding that to maturity. Right? So conservative investors, risk-averse investors. Right? So that's how markets behave. That's how markets fact these things. Okay? Then you see the concept of real versus nominal interest rates. Okay? This is a very interesting element where you have to understand what is the real interest rates and what is the nominal interest rates. The nominal interest rate is the interest rate, okay, you see in the market. What's the interest rates somebody quotes to you is the nominal interest rates. What is the interest rates people write in the newspapers, discuss in the electronic media? It is the nominal interest rate. Unless somebody precisely say real interest rates, all the time somebody speaks, it is nominal interest rate. Okay, so the nominal interest rate make no allowance for inflation. Right? So nominal interest rates do not factor the so-called inflation into the equation. Underneath, yes, nominal interest rate would have derived on the basis of that. But in discussion or the numbers that you are reflecting, there is no reference to inflation. But real interest rate is nothing but adjusted for changes in price level, that is inflation. So it more accurately reflects the cost of borrowing. Okay. So what you are basically seeing here is, if you are looking at a nominal interest rates of 7%, right? And you adjust that 7% to inflation of 5%, the real interest rate is 7 minus 5, that is 2. Real interest rate is the reflection of interest rate after adjusting for inflation or changes in price level. So effectively, that reflects the cost of borrowing. Why? The prices from today to tomorrow increases if the inflation persists. If inflation is 5%, today's price of 100 would become 105, let's say tomorrow or 1 year from now, right? So if the inflation is 5%, you see that change is there in the prices. So anybody whose 100 rupees worth today would not sufficient to buy the same goods and service 1 year from now or 1 day from now, the prices have increased by 5%. He can get less. So likewise, even if I have borrowed, that money is not sufficient because interest rates, inflation has eaten into the real goods I can purchase. So I have to simply adjust that element in my equation to say that my real cost of borrowing after adjusting inflation, because always inflation eats out the return I paid to the whoever lent it to me. He gets 7%, but 5% of that has gone to inflation because prices adjusted. So effectively, he, me, everybody in the economy affects by the inflation. At least not in the same way because our consumption patterns are different, but real interest rate matters for us and everybody. And that's where the real analysis underneath the interest rates behavior is looked at. Okay, so the nominal interest rate is the interest rates that you come across all the time and that doesn't make allowance for inflation. But the real interest rate is the interest rate that takes into account the changes in price level and more accurately reflect the cost of borrowing. Ex ante means before the event happens. Okay, real interest rate is adjusted for expected changes in price level. So today I'm looking at what's the real interest rate 1 year from now. Next year, real interest rate I have to express today. So how can I express it is by taking the expected inflation. Inflation today is the current inflation, but inflation 1 year from now is expected inflation. The central banks publish expected inflation, and if there is no expected inflation published by any agency in a country, you take current inflation as expected inflation. So you basically see today that I'm looking at an expected inflation of 5% for 1 year from now. Okay, so ex ante, before next year happens, today itself I look at it from the perspective of an 8% interest rate, nominal interest rate, and a 5% expected inflation, and I will conclude my real interest rate is ex ante 3%. Ex post is after the event. Ex ante before the event, ex post after the event. And after 1 year, you can adjust the interest rate to the nominal interest rate, so the actual inflation, whether it's 5% or 4.5%, you know by 1 year from now. So at that time, you can compare, oh, my ex ante real interest rate expectation was 3%, but now ex post, I have made it, right, 3.5% if the inflation is 4.5%. So that itself would give you certain direction in terms of interest rates behavior into the future. But these are very good elements, and this is derived from so-called Irving Fisher's Fisher equation. One of the very prominent equations in economics is Fisher equation. Irving Fisher, one of the famous economists, he has compiled this and stated that I, the nominal interest rate, is nothing but IR, real interest rate, plus phi E, expected inflation rate. Right? So what you are basically seeing is anybody looking at a nominal interest rate is he looks at his real interest rate expectation plus expected inflation. So always ex ante, I am looking future. I'm looking at what's happening 10 years from now. So I'm basically looking at what's my real interest rate, IR, plus expected inflation. Expected inflation, I presume it's 5%. Okay. So my real interest rate is 3.5%. So I want nominal interest rates of 8.5% today. So that's the conclusion. So that return is there. I'm happy. Okay. But interestingly, when the real interest rate is low, there are greater incentives to borrow and fewer incentives to lend. Because when the real interest rate is low, effectively, you are not paying much as a borrower. Because you know price increasing, expected inflation is there. But generally, the real interest rate in the past 10 years in Sri Lanka, somebody says 2%. Let's say, I'm not saying it's 2%. Somebody is saying it's 2% for assumption for the time being. But you can figure it out. 1 year treasury bill interest rates are now around 5%. 5.05 last week. Sri Lanka's CCPI inflation was 4.2%. So what's the real interest rate in Sri Lanka? Is less than 1% for 1 year treasury bills now. Right? So that's a computation, real information computation, fine. But you assume the expectation, my real interest rate expectation over the last 10 years in Sri Lanka happens to be 2%. And going forward, my inflation expectation for next 5 years is, let's say, 5%. So real interest rate 2, expected inflation 7, expected inflation 5. So the nominal interest rate should be 7. Real interest rate plus expected inflation. So nominal interest rate is 7, 2 plus 5. So anybody see the opportunities to borrow below 7, that means real interest rate is less than 2%. It's an incentive to borrow because he see, oh, my effective real cost of borrowing is now cheaper. But then the other side of the flip, other side of the coin is there are no lenders. Lenders would say, no, 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 no. Last 10 years, Sri Lanka had a real interest rates of 2. So why should I lend if the expected inflation is 5, below 7%? He would prefer to lend above 7%. And this borrower would prefer to borrow below 7%. So ideally, they both would come and settle at 7% based on the equation. So the market behaves like this. Okay, so the real interest rate is a better indicator of incentives to borrow and lend. When the real interest rate is slightly higher than its historical trend, there is more incentive to lend. When the real interest rate is slightly lower than the historical trend, there is more incentive to borrow. When it is higher, more incentive to lend. When it is lower, more incentive to borrow. So based on the circumstance in which that we are policymakers look at and experience the economic activities, they decide where the borrowing or lending behaves, and how to encourage, acclimatize people to get into the economic activity. So it's a very, very important policy yardstick, and also a very good indicator of real cost of borrowing. So please understand, the Fisher equation is one of the very important equation in economics, but very simple. The nominal interest rate is nothing but real interest rates plus expected inflation. So if you want to calculate real interest rate, if you have nominal interest rate and expected inflation, so I minus phi E equals IR. So equation I equals IR plus phi E, you take IR to the other side of the equation, then I minus IR is phi E, expected inflation. That's one thing. If you wanted to calculate real interest rate, you take phi E to the other side. Out of these three elements, you have two, you can calculate the third. Right? So if you see you are experiencing an environment where expected inflation is 5, nominal interest rate is 7. Expected inflation is 5, nominal interest rate is 7. So the real interest rate is 7 minus 5, 2. You are experiencing an environment, right? Nominal interest rate is, let's say, 8, and real interest rate is 1.5. Nominal interest rate is 8, real interest rate is 1.5. So what is the expected inflation? 8 minus 1.5, it is 6.5. So likewise, you adjust this equation and compute. Very simple. Just kind of put the thinking cap and adjust this equation. So Fisher equation tell this and try to give you an understanding in terms of how the real interest rates behave, and through which what is the incentive to borrow and lend in any economy. And policymakers take this as a very important yardstick in terms of activating the economic activities. So you can see from this chart here, the nominal interest rates in blue line and real interest rate estimated in red line. Okay, so you see the real interest rates and the nominal interest rates behavior. Generally, the nominal interest rates and real interest rates have a reasonable gap. You can see this gap, let's say from early 80s to mid 2000s, like 2005 to 2006, like the gap is reasonably steady. Okay, so you see the gap where the nominal interest rates decreases, real interest rates also decreases. So the points where you see here, the real interest rate is almost 0 and nominal interest rate is about 4%. Okay, so it is nothing but the expected inflation there. Then you see here, right, real interest rate is about 4% in 1989 line. Nominal interest rate here is about 8.5, let's say 8.5. Real interest rate is 4, nominal interest rate is 8.5, right? So 8.5 equals, sorry, 4 plus expected inflation. So what is expected inflation there is, it's about 4.5. Yes, it's 4.5, 8.5 minus 4, it's 4.5. So that's how you are looking at. But interestingly, the gap here is reasonably stable. But in recent period, nominal interest rates also hits almost the zero flow. This is financial crisis in 2008, 9, and then of course interest rates were reasonably low because of significant monetary easing policies practiced by the central banks. This is US, but all around the world they have practiced a monetary easing arrangement, right? So expansionary monetary policy that contributed to bring the interest rates to almost zero flow. So the nominal interest rates are effectively closer to zero. And effectively, you are simply seeing real interest rate is negative in most of the cases. Right? So negative real interest rates, almost flow level nominal interest rates, let's say 1%. Here it's not 1%, it's almost 0.25% in most of the time. Even now in US, the 1-year treasury bill rate is about 0.3%, 0.25% or about 30 basis points, right? So 0.25% equals nominal interest rate, real interest rates of -2. So what is the expected inflation in US? To see a situation like this. So what you are basically seeing here is, right, the negative real interest rates of 2% has to go to the other side of the equation. So 0.25% plus minus here goes to the other side, become positive. So it becomes 2.25. Right? So you are basically seeing a situation where negative real interest rate is also persistent at times. And even here, you can see between 75 and 80 period, yes, the real interest rates were negative, but nominal interest rates were very high. So during this period, inflation would have been more than the nominal interest rates, right? So the inflation would have been higher than the nominal interest rates in US. Yes, this is the period where US had oil price shock. You can check those stuff. So this is very real economic application and economic situation the countries have experienced, right? So nominal interest rates looks negative, right? Sorry, real interest rates looks negative when the inflations are often greater than the nominal interest rates. So I equals IR plus phi E. You can turn around and explain to say that where are the direction of these very important economic indicators, economic variables, and through which you can apply and derive number of policy decisions. We will not get into that type of analysis here. That is very much for further studies. But general understanding is Fisher equation is one of the very important elements that derives the real cost of financing in terms of incentivizing lending and borrowing. So that's the message I wanted to give you all through this discussion. Okay, so with that note, we complete this section. This is a very important, very interesting section. That's why I took a little time also in terms of explaining some of these stuff. But you will see in coming discussions, you will apply some of these stuff. Those applications would help you to further understand the concepts that we discuss here. These concepts that you discussed here would be useful in not only your analytical and study purposes, but also realistically how you are looking at in terms of interest rates behavior. So you have another lecture in terms of presentation slides, where we will look at the interest rate behavior, or the behavior of interest rates. This is understanding of interest rates. Now we will be looking at behavior of interest rate. So this is also a very important area for you to understand this subject elements. But I will start fresh at our next class. Okay, and please read through. You will get some of these elements. Here itself you see nominal interest rates. You will see the real interest rates, the interest rates levels, all kind of things being discussed. So at least you will try to get some understanding in terms of where the interest rates are and how the interest rates are applied in real circumstances. So I'll just mention that for the time being. Any questions? Right. So if you simply see no further clarifications required, we will stop at this point, and we will start with our second lecture presentation that we have shared with you all today in our next class, and we'll be able to see some of this being explained in greater detail. Okay, so we'll see you next week, and stay safe.